The purpose of central banks like the Fed is to protect the banks, not you.
Some experts worry that the dollar's dominance may be under threat.
For decades, our country has been looted, pillaged, and plundered by nations near and far, both friend and foe alike.
When you're saving those fake dollars, this will still be here. This could be the biggest opportunity you'll ever see.
What's up, guys? It's Graham here, and this is unbelievable. In the middle of tariff negotiations, retaliation from China, a weakening dollar, and global uncertainty, one investment has quite literally become the ultimate money printer, and that would be gold. That's right, while trillions of dollars are being erased from stocks in a matter of hours, gold is up nearly 30% year to date. It just hit its 55th record high in the last 12 months, and even Donald Trump just said that he who has the gold makes the rules. I mean, it's rather incredible, but with some analysts now calling for gold to potentially hit as high as $5,000 an ounce, we should really discuss why investors are suddenly cashing out and buying safe haven assets, how gold is quickly becoming the best performing asset of 2025, and if it's too late to buy in. Because despite gold now outperforming the stock market over the last 8 years, there are some major risks that everybody should be made aware of, especially before it's too late. Although before we start, as usual, if you appreciate breaking news videos like this, it would seriously mean the world to me if you hit the like button or subscribed. If you haven't done that already, it does actually make a tremendous difference for the entire channel, and as a token of my appreciation, I will do my best to read and reply to as many of your comments as I can. So thanks so much, and also big thank you to Incogni for sponsoring this video, but more on that later. Alright, so in order to understand why gold has become such a popular investment and how high it could potentially go, we need to start here: currency. Unlike the US dollar, or really any fake money that could just be printed out of thin air, gold has been used as a viable currency for thousands of years. After all, it's difficult to come by, it doesn't rust, it doesn't tarnish, it doesn't degrade, it's easily moldable, it's functional, and it's so rare that all the gold mined in the world could fit in a 23-meter cube. However, in terms of the United States, gold didn't really make a formal appearance until 1792, when Congress passed what's called the Mint and Coinage Act, which created gold and silver coins in various denominations. From there, other countries around the world wanted to standardize payments for global trade, so the gold standard was adopted. This guaranteed that the government would redeem any amount of paper money for its value in physical gold, meaning transactions no longer had to be performed by handing over heavy bars, but rather paper currency that could later be redeemed for gold at the bank. This worked incredibly well for decades, until it didn't. After the Great Depression, in 1933, people began getting rid of their paper money in exchange for physical gold, and as demand skyrocketed, bank reserves started running low. So as a way to stop demand from outstripping supply, President Franklin D Roosevelt and the government signed Executive Order 6102, which banned private ownership of gold and required that all citizens give back their physical gold in exchange for paper money. This resulted in the US government now having the largest stockpile of gold in the entire world. And after World War II, most countries simply pegged the value of their currency to the value of the dollar because our dollars were backed by gold. So if they had a dollar, it was theoretically just as good. Again, until it wasn't. See, in 1970, the United States budget was ruined by the Vietnam War. Global demand for gold began increasing faster than what any reasonable currency could keep up with. So as a way to help introduce more money into the economy, our dollar was removed from the gold standard, allowing the government to pretty much do whatever they want. And from this point on, our money was only backed by the belief that it is worth what they say it is. This resulted in the demand for gold skyrocketing, going from $35 an ounce in 1970 to $594 in 1980, which works out to be $2,445 in today's prices adjusted for inflation. Over the next 30 years, however, the value of the dollar eventually stabilized. Gold prices remained fairly flat, and every time the government seems to print more money, the price of gold continues on its trend to the next all-time high. So does this make it a really good investment? Well, so far, in terms of what gold can buy you, overall it's held its value incredibly well. For instance, since the United States abandoned the gold standard, the value of our dollar has dropped 85%, while the price of gold has increased 85 times. In this case, even though the stock market has become the default wealth builder, anytime inflation runs high or global uncertainty increases, the price of gold continues to jump higher because it's seen as a hedge against a falling dollar. Even better, but when you take a look at its performance, there are three main points to consider. 1. Gold has outperformed US bonds, commodities, and global stocks over the last 20 years. Now, even though the US stock market technically has higher returns, over the last decade, gold has seen an annualized return of 8.3%. And during times of economic unrest, gold not only remains fairly stable, but it also makes a lot of money. Leading to number 2, gold outperforms the stock market in times of volatility. For example, during Black Monday of 1987, when stocks dropped 30%, gold barely had any change. From there, gold only fell 12% during the dot-com crash compared to 44% for the S&P 500. And during the COVID crisis, while markets dropped 20%, gold dropped by only 0.86%. And 3, it is highly liquid and lags only the S&P 500 in terms of trading volume, meaning you could sell it at any time. However, if you think that gold has become the inverse of the stock market, where it only goes up while everything else is going down, well, unfortunately, you're going to be somewhat disappointed. As Ben Carlson of the Wealth of Common Sense blog points out, the monthly correlation between the stock market and gold is essentially zero over the long haul, and even over decades, it's still rather unpredictable. Like, both stocks and gold rallied at the same time throughout the 1980s, 2010s, and 2020s. While inflation remained high in 2022, gold remained completely unresponsive. And only recently did the price begin to come to life, now that we're seeing global unrest and lost confidence in the dollar. Although in terms of what could happen throughout the next year, and how high gold prices could potentially go, you're going to want to hear this. Although before we go into that, I just have to say I am shocked that people do anything they can to protect their investments, but do nothing whatsoever to protect their personal data. Like, here's the thing, anytime you give out your personal information, sign up for a product or service, or make a purchase, your information is being sold and passed around, resulting in spam phone calls, emails, and phishing attempts that are only becoming more common. Now, even though this sounds crazy, thankfully you do have a right to protect your privacy and request the data brokers remove the information they have about you. And even though this could take forever to do yourself, our sponsor Incogni is there to help. They do all the work for you by reaching out to data brokers on your behalf, requesting that your personal data be removed, and dealing with any objections that websites or data brokers might have. And since a lot of these data brokers continue collecting your information even after they've removed it, Incogni makes sure your information stays off the market by conducting repeated removal requests. All you have to do is create an account, grant them the right to work for you, and then sit back while they keep you updated every step of the way. They're also available risk-free for 30 days, so anyone's able to try it out and give it a shot and get a full refund if you're not 100% satisfied. To me, this is the perfect way to reduce the amount of spam phone calls and emails and phishing attempts we all seem to get on a daily basis, and if you don't make an active effort to remove it, it's probably just going to keep getting worse. So if you're interested in having your personal data taken down, check out Incogni at incogni.com/Graham, and make sure to use the code Graham at checkout to get 60% off an annual plan. Or you could also use the link down below in the description. Thank you so much, enjoy, and now let's get back to the video. Alright, so in terms of gold as an investment and how much money you could potentially make, let's talk about profit. It's important to clarify that prior to 1971, the price of gold was fixed by the government at just $35 an ounce, since our dollar was held to the gold standard and this money had to remain stable. This is why most gold charts really only start around this point, giving us 54 years of data to look back on. And here's where things get very interesting. As Ben Carlson mentions, who I'll link to down below in the description, by the way, for anyone who wants to follow along, from 1971 to 79, the price of gold increased by 1,300%, or a compounded annual return of 33.8% a year. Now, even though this seems like an amazing return, many people believe that this was simply the market playing catch-up from the government artificially keeping the price substantially low, at again, just $35 an ounce. This is why, to get an accurate understanding of how much gold actually goes up in value, we need to look at the prices beginning in 1980, which paints a completely different picture. For instance, from 1980 to 2023, the price of gold increased by just 3.2% a year, lagging stocks at 11.7%, bonds at 6.5%, and cash at 4%. At the same time throughout all of this, inflation averaged 3.2%, meaning over 44 years, the price of gold increased by pretty much nothing. Now, even though this might sound pretty discouraging, during an economic crisis, gold actually holds up pretty well, or if anything, goes up while everything else is losing money. For example, from 2000 to 2009, the S&P 500 fell while gold rose more than 14%. Even from 2000 to 2023, gold is up an annualized 8.5% a year compared to the S&P 500 at 7%. However, if we just change these dates slightly, from 2009 to 2023, the S&P 500 is up 13.8% a year compared to gold at just 6% a year. And even at today's prices, with the market falling and gold skyrocketing to new all-time highs, gold is still up an average of 5% a year from 1981 through today, while the S&P 500 increased by 8.8%. And this is where some very unique trends begin to emerge. Generally, gold outperforms during times of high inflation, economic uncertainty, and global turmoil that results in the dollar falling in value. And since gold is completely detached from the government, people rush to buy into it while financial institutions are under pressure, like they are right now. Although in terms of whether or not it's a good time to buy, here's what I found very interesting: the gold to S&P 500 ratio. This tracks how many ounces of gold is required to purchase the S&P 500 index. The higher the ratio, the more valuable stocks become relative to gold. And the lower it goes, the more valuable gold becomes during economic uncertainty. This consistently tracks back to 1928, and when the S&P 500 takes just 1 ounce of gold to purchase, it's usually a pretty good time to buy into stocks. Now, obviously, this ratio isn't perfect, and there are several different aspects to take into consideration, but generally, when economic uncertainty is high, gold does well. And that's why several analysts believe that if this trend continues, gold could go even higher. For example, the billionaire Jeffrey Gundlach believes that we could see 4,000. Goldman Sachs believes we could hit 4,500 in an extreme case scenario. And Rob McEwen predicts that even $5,000 could be in the cards, even though he owns a mining company and could be a bit biased, but that is besides the point. Generally speaking, the worse our economy does, the better gold is going to do. And even when you look at the value of our US dollar, 152 currencies have failed from hyperinflation, and we've never had a reserve currency last longer than 110 years, all pointing to the fact that being diversified right now is a good thing. Although in terms of investing in gold at today's prices and where it might go in the future, here's what I think. Overall, I treat gold as a hedge against one thing, and that would be fear. The more people fear inflation, defaults, economic collapse, and the downward spiral of the US dollar, the higher gold becomes. And right now, we have a lot of fear. Like in just the last 24 hours, the chairman of the Federal Reserve, Jerome Powell, was called a major loser for not lowering interest rates. And Trump is reportedly studying as to whether or not they could legally fire the central bank leader before his term is set to expire. We also have China vowing to retaliate. They're warning other countries not to undercut them in negotiations. And as we get closer to the deadline of 90-day tariff pauses, it doesn't seem like much progress is being made. This is why gold continues going higher, while the value of the dollar keeps getting weaker. But this doesn't mean it's going to continue happening in the same trajectory. That's because when it comes to gold, the higher the price rises, in a lot of cases, the better of a value stocks become. And the higher stocks rise, the better of a value gold becomes. At least when you zoom out over decades. Like sure, over certain periods, you absolutely have times where gold outperforms the stock market, or the stock market outperforms gold. And it's really just about cherry picking the select dates that fit whatever narrative you want to get across. This is why I don't see gold as a replacement for long-term investing or something to YOLO all of your money into, but rather a way to diversify part of your portfolio to give you something else to fall back on. This is also why a good portfolio isn't just one investment, but rather a mix of different asset classes, all of which are meant to help you stabilize during times of economic uncertainty. Like in my case, I have a mix between cash, treasuries, US stocks, international stocks, real estate, and a Bitcoin ETF. I'm quite literally invested in just about everything throughout the entire world. All of these are in varying amounts, and if the market continues falling, I have cash and treasuries to buy in cheaper, and if the market goes back up, well, I'm still invested. I haven't sold anything, and I get to capture all of the upside as well. Honestly, in my opinion, an allocation to gold wouldn't hurt, and over the last year, you actually would have made a lot of money. It's just not something that you're supposed to go all in on, or YOLO to try to make as much money as possible. Really, the strength of gold is simply its ability to store value and be around in times of economic uncertainty to hedge against everything else falling. And most models seem to forecast that it's a good idea to hold between 5 to 15% of your portfolio and no more than that. But for me, I would rather just invest a little more aggressively. I don't mind the volatility, and since I have a long-term outlook of the next 30 years, that tends to to suggest that stocks still beat gold over the long term, and that's the way I'm generally going. Sure, this could very well underperform in the short term, but then again, I'm just a dude in a half-converted garage making YouTube videos, and I have no idea what I'm talking about. So if you agree or disagree with me, let me know down below in the comment section, and I will do my best to read and reply to as many of you guys as I can. And also, make sure to hit the like button, subscribe if you haven't done that already. Sincerely, it means a lot. Thank you so much, and until next time.